I tell my students there are three main reasons why you need to refi or why you should refi. We've already briefly talked on two reasons. I pulled equity out. That's one big reason if you have a lot of equity in, and this works for single family. It works for commercial properties as well. Commercial properties appreciate, and you build up equity in those, so you can pull those out too. A lot of times, if you're in have investors, you can give them a portion of their initial capital back, so they can redeploy it in other investments. The second one that you touched on is to get a better interest rate. If you can lower your payments every month, that helps quite a bit. If you're going from say 10% down to 4%, that's a huge savings. And then the third reason that I tell them is because one, you have to, your loan is maturing, you have to pay it off, or the bank's going to come in and take over ownership. So
Yeah, a lot of people forget, especially on the commercial side. Usually, you're not doing a fully amortizing loan, like a 30-year loan paid off in 30 years. You might be amortizing for 30 years, but it might be a 10-year balloon or a 5-year balloon.
welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got Frank Patalano with me here today. How are you doing, Frank?
Good, sir.
So in the last few episodes, we did like a little mini series, and we'll probably do some more whenever we hit topics that go beyond like our normal recording threshold. But we did a little mini series on vetting a sponsor. So if you're interested in that, you can catch those. It was a 3-part episode. But today, since we are in the middle of one ourselves and we are seeing a lot of things going sideways with it, let's talk about refinancing. How does that sound to you?
Dum dum dum. Refinancing.
What is refinancing, Frank?
I mean, most of the time when people are buying a property, they're leveraging a little bit. They're getting debt on the property, and whether that debt is fixed or variable, refinancing is just getting new debt. It's
So
the simplest way,
actually,
right?
yeah, and actually I've seen like large funds when they buy a property, they'll pay for it in like cash. And then once they secure the property, then they'll finance it or refinance. I guess it's technically a finance because they haven't financed it yet, but you already own the property and you're getting a loan on it. That's typically what I call a refinance. So then they pull all their equity out and then they go do it another one. So
Yeah, I mean, like I said, this is all about leverage. Can you do deals? I mean, I've flipped houses all cash before, but you refinance to be able to use leverage to your advantage.
yeah, I mean, you've also bought a hotel all cash before too. So
Uh, I would consider that an aggressive seller financing strategy. It did take me 4 months to pay off the loan.
oh, okay. Um, Refinancing can be a super strategy if you pay attention to bigger pockets and their Burr method, the buy, rehab, rent, refinance, repeat, or whatever. If I got them in the right order, they put refinance. Typically, you do that for like residential stuff, and it works. I've done that with residential stuff long before I even heard of the Burr method. And the cool thing about that is I had a house, bought it 20 plus years ago, and as you're making payments on it, as so you're renting it out and making payments, as everything's going up, your house has appreciated in value, your equity increases, and so a refinance allows you to pull some of that equity out to use that money for other things. In my specific case, I've probably refinanced that house at least twice, pulled the equity out, and it's always fun going to the title company, signing all your documents, and then telling the title company they owe you $18,000 instead of you owing them 18,000.
When I think of refinance, obviously I joked that on my shoulders I have like an angel and devil and Robert Kiyosaki on one side and Dave Ramsey on the other. So, especially on the residential side. And the problem with owning things with no debt, with completely owning it, is your return on equity is quite low. You know, if you have a $300,000 house and you're making $300 a month or even $1,000 a month in profit, that is a good amount lower than if your equity on a property is only $50,000 and you can make, $500 a month profit. So
Yeah, but I can see both ways. For instance, my parents, they have rental properties. They paid off all of their debt as soon as they could. Of course, they are older, and really they're thinking about the next generation. They don't want to pass down debt, even though it's going to be paid for by the residents. Um, but whenever it passes hands, they just want it like free and clear, so that one, I don't have to worry about the debt on all their properties. So I can understand that. I don't necessarily agree with it, but I think maybe there's a point in time where I just don't want to have to worry about it again. And maybe when I'm like
yeah,
70
yeah.
years old, is like, I just want to pay it off and just and not worry about it anymore. I've lived a pretty good life. So
So another problem if you don't refinance, I've seen it where, especially if you're using third-party property management, where property management becomes lazy in some ways, where they're not pushing rents at all. And I have some properties where, because we bought it so cheap and so many years ago and didn't refi them, the rents haven't gone up like at all.
yeah,
And you get to a point where the delta between um, the normal rent in the market and your rent on your property could be $500 a month. And it's like, and that's because since we didn't refi and since the payment stayed the same, nobody felt any pressure to do anything. But at the same point, if you're not fixing up the unit, sometimes you start to fall behind on future capex. But yeah, so back to refinancing on the personal side. On my own personal house, I've refied twice. Uh, the first time we took no money out, we went for a shorter term and a lower interest rate. We went from a 30-year to a 20-year, and I think our rate went from like 6 and 3/8 at the time to 4.99 or something. And the second one, we also reduced the time and we reduced the interest rate, and we were able to refi with no closing costs. It didn't get figured into the loan, but because we stayed with the same bank or financial institution, they actually let us do it with. I guess they wanted to switch people to a new program, and we were lucky enough to get the new program. We did a 12-year at 2.99 with no closing costs, so we've done pretty well on that over the years.
yeah. So generally, I tell my students there are three main reasons why you need to refi or why you should refi. Um, we've already briefly talked on two reasons. I pulled equity out. That's one big reason if you have a lot of equity in, and this works for single family. It works for commercial properties as well. Commercial properties appreciate, and you build up equity in those, so you can pull those out too. A lot of times, if you're in have investors, you can give them a portion of their initial capital back, so they can redeploy it in other investments. If it's your own stuff, then that's more money in your pocket, and maybe you can pull some of the equity out, and you can do maybe some deferred maintenance that needs to be done that you've been putting off, just because that happens over time. The second one that you touched on is to get a better interest rate. If you can lower your payments every month, that helps quite a bit. If you're going from say 10% down to 4%, that's a huge savings.
Yep.
Even if you go maybe amortize from 15 to a 30 year, something like that, that can lower your payments as well. Um, Again, this is going against Dave Ramsey. He's all about the 15 or less amortization mortgage, but that's a whole other topic. And then the third reason that I tell them is because one, you have to. Your loan is maturing, you have to pay it off, or the bank's going to come in and take over ownership. So
Yeah, a lot of people forget, especially on the commercial side. Usually, you're not doing a fully amortizing loan, like a 30-year loan paid off in 30 years. You might be amortizing for 30 years, but it might be a 10-year balloon or a 5-year balloon.
yeah. Or if you're even in a bridge loan or something like that, it could be less. It could be a 2 year
Yeah, it
to
could be two
4 year.
years interest only, where you haven't paid any of the principal.
Yep. So
Yep.
there's those are the three main reasons that I see to do a refi. I honestly can't think of any other reasons why I might want to. Because one, it's a long, arduous process, and I don't really care for it personally. I've had bad relations with banks on some of my refinances because people are stupid. Not necessarily the bank, but the people handling the loans. Um, but one thing that I also tell my students is refinance when you can and it makes sense, but don't necessarily put it into your business plan. So if you have a 10-year note at 6% interest and that's what you're running your underwriting at for a 5-year hold, you don't need to do a refi in it because your loan's not going to mature before you get rid of it. However, if you're in the middle and you're year two and interest rates have dropped, or you get a better loan product, and now you can, instead of 6%, you're looking at 4%, and you can save significant debt service every month. That's better returns for your investors. Plus, you'd probably be able to pull out some equity and return it to your investors. So that's really good too. But again, I recommend that you don't put that into your business plan because it's nearly impossible, or it is impossible to predict what the interest rates, what the loan terms, what the cap rates are going to be at the time you plan on refining. That makes sense?
Definitely. I'm just thinking back to your three. I'll change the wording on one, but the three main reasons why people would do a refinance. One would be to pull out equity. Two would be for better terms, or three because it's maturing. And
Yeah.
I said better terms because interest rate is the main term. But like you said, if you decide that there's a certain reason why you want a much longer time horizon, one of the big things, probably about I don't know 3 or 4 months ago, is there was this big discussion slash online argument about offering 50-year mortgages and whether that was good or bad. You remember this? A few months
I
ago?
I've heard that Trump, again, this is December-ish, winter of 25, maybe early 26 when this episode's coming out, just to give you listeners a timeline. But there is talk about a 50-year mortgage.
Yeah,
And I also saw a Dave Ramsey clip on it saying the difference between a 50-year mortgage and a 30-year mortgage,
there's a
or
lot
yeah,
more interest.
is a whole lot more interest and like 100 or 200 savings a month. So don't go with the long term.
Well, I mean, there's also the argument when we think about commercial properties and we think about inflation and when we think about the fact that money has become more of a debt instrument for the US government. Just those concepts alone, I know people that'll keep loans forever.
Yeah. I mean, it loans leveraging, the way lever works is you can move something big with very little power. That's why it's called leveraging. And so you can buy a big apartment, or you can buy a house or whatever with significantly less money than it's worth because of leveraging. And so I mean, there's reasons to use leveraging. There's reasons for debt. Um, and if you use it for the right reasons, you can be successful in what you do. It's this is where Dave Ramsey comes. Is you don't want to refinance a house, take all your equity out, and then go spend it all on a European vacation or go spend it all on a new car or something like that. You want to put it into another asset that's going to start helping you increase your wealth. Or that's what I tell my students. That's
Yeah.
I mean, everybody can
I,
do
I'm
what they want, but
I'm just joking with the concept that if somebody offered me a 100-year loan, where I'm paying a 2.5% interest rate, um, why wouldn't somebody want to pick that up, especially when was the last time that inflation was below 2.5%? Real inflation.
what if they gave you 100-year loan and it was 7.5% or
Yeah,
five and
no,
a
see
half
that's
percent?
that's a whole different ball of wax. I'm playing with you in some ways. Yeah, that's why I said better terms as well.
Yeah. So um some issues that we've had with free financing, and like I said, it could be a painful experience. Um,
Yes, it can.
even my single family stuff has been painful. I refinanced my main house that I live in, my main residence, just to get a better interest rate. I didn't pull any equity out, and I ended up leaving that bank altogether because that mortgage loan officers was just horrendous. And then like at the end, it's like, is there a survey I get to fill? As well, you just have to buy a survey. It's like $3,000. Like, no, I don't want a survey of the property. I want a survey on how well you're doing because you suck at.
He confused what kind of survey you were looking for.
Yeah. Um,
I feel
but
that a lot of banks definitely give a hard time pulling equity out. Cash out refis are definitely harder than just refining to get better terms.
yeah. Um, I think if you go and actually, it was a bank that first told me about a cash out refinance. That's when I was learning I can pull equity out. And they helped me, and I use like a conventional mortgage lender for that. Subsequently, I've used commercial lenders, even for my single family residences.
Yep, me
They'll
too.
they'll do it. You pay a little bit higher interest rate, but I mean, it's so much easier. Instead of what 60 to 90 days close, you get it done in like 30 or whatever for my single family.
Uh, every bank is different. I don't think I've ever done a 30-day, but you know, on the refinance side, one of the things you mentioned was that on the multifamilies, not to put a refi. You usually coach your students not to put a refi into the model, into the business plan. I would say that most of the time I do see one. We've successfully done a few of them, and then we've had some that did not go as well. I'm not saying they were a disaster, but one of the better ones that we did. I'll give you examples of two good ones that we did. We had one, the Idaho deal that we bought in 2020. We refied it 2 years, which was right before interest rates started going up. So I don't know what the original rate was, but it was something high. It was bridge. It was temporary. We were able to get into a Fannie Mae um, 5 year at 4% in
Okay,
uh, in the middle of 22, right before interest rates went up, and we were able to give half our investors got half their money back on the deal, which was nice.
cool. But let me ask, did you put or whoever underwrote it, did they put the refinance in the underwriting?
Yes.
Did y'all match the terms that they put in the underwriting, or do you know?
I don't know if we matched the interest rate. We did give 50% back because that's what we had planned on giving back to the investors based on the refi.
Okay. So a
Um,
tip, I would say that's not normally the case. I mean, you shoot for it and you have a goal to do it, but um, kudos to you being able to do it. So
I wasn't saying it was the best idea because what happened was that left us a little too cash strapped for some of the capex and other things after reading the PCA report of what they wanted fixed in order to give us the loan after we got the loan.
mm,
This was the one that had the big parking lot slash driveway issue where we reserved $40,000 to replace the driveway, and in the end, they expected a $200,000 new parking lot.
yeah,
It's like, yeah, that can't happen. This was a smaller deal too. Another example of a refi was in Massachusetts. We did a refi last year. We had bought it. We had bought it last year. We actually did the refi earlier this year. and we bought it about $89,000 a door. We had about $15,000 a door of rehab figured in. So you're in for about 104, 105. And we refied with appraisals of around 140 to 150 a door. And everybody's able to get about 75% of their money back.
That's cool.
Yeah. But that doesn't, like
Um,
I said, that doesn't always happen, but those are just examples.
yeah. I did want to touch on this. It's like you've heard us say cash out refinance, where we get equity or cash into our pocket during a refinance. But you can also have a cash in refinance.
Oof,
And
painful.
yes, this is when, and this is we almost had this on our own property where we owe say $4 million on a loan, and we're trying to refinance, and every loan we get is coming in. We can get a loan for like 3.5, 3.8 million. So that means to get out of our existing loan, we would have to come up with 200 to $500,000 of our own money just to get out of a loan and into something else. So that would be a cash in refinance. And I think typically you would only want to do that if your existing loan is maturing and you have to get out of it. I don't know why anyone would want to. I guess it could make sense if you get better terms and the cash in is minimal, maybe. But
Yeah,
um,
I would say that if you're going from a hard money loan at 12% to something like in the 5% range, it'd probably be worth it. But overall, no, I agree with you that the main reason why you would do it is because you have no other choice and you don't want to lose the property. And it's not the numbers don't work to sell it either.
yeah,
Because, I mean, when you buy a property and then you have decisions to make as after you do the business plan, you refi it, you sell it, you keep it for a few more years, and then you make that same decision again where you refi it or sell it. Right?
yep,
Those are basically, well, I guess the three options are you hold it till you pay the debt off, you refi it to get new debt and pay people out equity, or you sell it. Those are the three main end strategies, right?
yeah. And we talked about exit strategies a few episodes ago, but yeah, that's pretty much all you can do.
Yep. So,
So
for example, right now, I'm looking at one deal that Jason, you know about that we just don't like the bank. The bank has given us a hard time in some ways, and I don't think they really understand the market. So we have started to entertain doing a refi just to move to a different lender. We haven't really pushed it that hard because obviously we have another loan that's maturing and we have different things to worry about. But we're definitely looking at it as a possibility.
yeah. I guess there should be a fourth reason for doing a refi. That's because you don't like the bank.
Yeah, we didn't
but
put that on the list. I guess that's not because it's maturing.
but it could be better terms, maybe. They're
Yeah.
more friendly than this other bank.
One of my business partners, we had a small local credit union that used to always make us fill out a ton of paperwork every single year, and we would call that our annual harassment. You know.
I have to send a whole bunch of paperwork in my tax returns to every lender that I have every year.
Yeah. I think it's because that was one of our first commercial lenders that we didn't understand it as much, so we just gave them a hard time because it was an easy thing to do. But no, Robert Kiyosaki talks about this, Rich Dad Poor Dad. He talks that when your banker doesn't ask for your report card in school, but they will ask for your P&L, your income and expense,
Yeah, and your
how you're doing,
PFS
your
and
net worth
everything
sheet.
is. Yeah, yeah. They go through all those documents with a fine tooth comb. So
You're not kidding. I've been called out on why one of my other properties has a debt service coverage ratio of 0.9, and it's like you do realize that I have other properties that have no debt on it at all. So even if you really looked at it, I have I have no debt service on that one. So just combine it with that one and see if it makes the numbers. And of course, it made the numbers.
yeah, that that's or on this is your residential stuff or
No, no,
your
no.
personal stuff.
Well, small, but it was commercial loans, but it was it's small multifamily.
Like
So we would
your
we have
pers your personal or
no,
partnership.
no, in our LLCs, we'd have like a couple triplexes that were on one, and one of them had like a vacancy and an eviction and a good amount of rehab that needed to be done. So that number didn't look as good that year on one of the triplexes, but on the same LLC, we had a different triplex that had zero debt at all.
Okay, so
So
it was the same LLC. That's what I was getting at. It's like,
yeah, same
because if
LLC.
it was a different LLC, they wouldn't have been able to do that, or they shouldn't have been able to do that.
They shouldn't have been able to do that. I agree. It just happened that both of the LLCs had the same partners. But yes,
Yeah. Okay. Banking can get convoluted, and and,
absolutely.
and bankers are people too, and they like to cut corners or make things easier for them if they can. They're not necessarily out to get us, but to make they don't want any like burdens or additional burdens on themselves, I think.
They want to protect their job.
Yeah. Protect their job with the least amount of effort possible, usually.
There you go.
So,
So, what else do we want to talk about with refinancing?
so I mean, we talked about residential, talked about some commercial. I don't know what else is there to talk about refinancing.
I mean, sometimes you have to plan ahead on, even though we're not experts and we don't know which way rates are going, sometimes you need to make decisions on where you think rates might go. So sometimes you'll be looking at whether it's agency debt or any kind of debt, and you'll have a bunch of different options. And those options will include different timelines, they'll include different interest rates, they'll include different types of yield maintenance or prepayment penalties, or sometimes we have to crystal ball into the future
Yeah.
to make a decision on what's best.
And this is also, if you're thinking about it going into the future, then you can also stress test. If say you're getting a bridge loan, your bridge loan is a 2 year loan, but your hold period is 5 years. You have to put a refinance into that business plan, because otherwise the bridge company is going to take your property at the end of 2 years. So you have to put it in there. So what then you should do is start stress testing, do a sensitivity analysis on, say, all right, what if refi um, rates are, and then you just put in some that you think might happen, like 1 to 2 points higher, 1 to 2 points lower, maybe even go like 5 points higher, just to see what happens and see if it still works out. Again, nobody has a crystal ball, or at least no one has one that can tell the future, and so you have to use your best judgment and pull on the experience you have. But um, that's how
I,
you can handle it, is just run a bunch of different scenarios, or say or stress test it or so whatever.
I would say when you're getting ready for a refinance, you have to double check your expenses and your income with a fine tooth comb. When you're 3 months out, you might offer, especially if you have a lower occupancy than you had hoped, you might offer a rent special that you can burn off, where maybe they come in with $200 off for the first 2 months or
Yeah.
something like that.
And I mean, when we were planning for our refinance for our property, we went in months ahead knowing we were going to do it. So we went in knowing we need to start increasing our NOI to make this property as valuable as possible. Um, and then we ended up paying for an appraisal too, that was beneficial. But it's like, so we had to get the management team on board as well to start lowering expenses, increasing revenue as much as they can, just to get that NOI up, so that whenever it comes time to refi, we have a better valuation of the property than before. So, and I'm freezing up.
No, you're good on my end.
Okay.
But besides that, yeah, I think we've talked everything we can talk about with refinancing.
Yep. So if you want to learn more about refinancing, you can look me up, ironcladunderwriting.com. Frank and I are both on LinkedIn. Frank's getting more active on LinkedIn. He's on Facebook. I'm on Facebook, Instagram, YouTube, whatever platform you're listening to this on. And we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.